Hi, everyone. Thank you so much for joining me today. I'm really looking forward to spending the next half an hour with you. Just going to flick over to my introduction screen here. So my name is Jennifer Daniel, and I'm a financial advisor and insurance advisor with GP Wealth Management at 415 Fairview Drive in Brantford. I'm actually at my office today. However, over the past year or so, because of the pandemic, most of the time I'm not meeting my clients in the office. Instead, we're doing a lot more phone calls and Zoom calls like we're doing here today. Now, my number one goal as an advisor is to take what seems like complicated tax and financial information and really simplify it for my clients and individuals like yourselves so that you can feel confident that you're maximizing all of the opportunities out there within the complex framework of our tax system in Canada. So that's really my goal overall as an advisor, but also my goal for us today is to keep things simple. So I look forward to the next half an hour with you. We're going to discuss 6 key facts that I think are very important for people over 60. Now, some or all of these facts could be helpful to you, or perhaps they may be helpful for a friend or for a family member. So please take some notes as we go. And please also don't worry that there are going to be more detailed notes provided to you as a follow-up from the presentation today. So what I've tried to do on our slides is keep them fairly simple. And as I provide more details in the discussion, those details will be captured in the follow-up notes that you'll receive. So if you miss something, don't be too concerned about it. When the presentation is done, we're also going to take time at the end for questions. So, if there's a question that you think of as we go along, please feel free to make note and we can discuss it at the end. Or if you're more comfortable, I'm open to you reaching out to me to ask those questions. So what I wanted to do on this first slide here is just provide my contact information. If there is anything I can do to help you, I am here. You can call me, text me, or send an email. So my cell number and my email are listed on this slide, and they'll also be included in the follow-up. Feel free to reach out with any and all questions. There's absolutely no cost, and I'm happy to help. Also, I've added my website, gpwealth.ca, to the presentation here. So let's go through what we're going to cover today. So this is an overview of the 6 facts that we're going to be discussing. So the first fact we're going to discuss is when you can stop contributing to CPP. So if you're in your 60s in particular and still working, you may be wondering when you can stop contributing to CPP. We're going to discuss that. The second fact we're going to look into is how you can share CPP with your spouse in order to reduce your household income taxes. This is important to note. It's not income splitting of your pension income. This is actually CPP sharing. So we're going to talk about this. I don't think a lot of people are aware. So this will be a great fact to take away. The third fact we're going to discuss is when you can start collecting CPP. So this may be useful for you or for somebody you know. It's not just age 65. That seems to be the magic number that we all have in our heads as to when you can start collecting. In fact, you do have other options, and we're going to talk about those today. The fourth fact we're going to review is OAS, the OAS benefit for those age 65 and over. We're also going to discuss GIS, which is the Guaranteed Income Supplement benefit, which is for lower income seniors age 65 and up. And then finally, we're going to discuss how to start saving now using TFSAs or tax-free savings accounts. And I would say that for everyone on this call, if you're not currently using a tax-free savings account, there is likely a benefit for you to do so. So we're going to dig into that a little bit and give you some ideas on how you can start saving with tax-frees. All right, so let's get started on our first fact. The first fact I'm excited to share is that you can actually stop contributing to CPP at age 65. So for those of you in your 60s, or if you're going to be approaching your 60s in the next few years, it's important to note that if you are working, whether it's full-time or part-time, it is required that your workplace deduct CPP contributions up to age 65. Now, once you turn 65, you can actually opt to stop contributing to CPP. This is something, though, you'll need to request. It's not something that happens automatically. And in many cases, employers continue to deduct CPP contributions up to age 70. So if you're interested in stopping your contributions, you'll specifically need to complete a form, CPT 30, and give a copy to your employer and the original to CRA. So with this fact, you might be thinking, okay, how could this help? Well, if you stop your CPP contributions, it's going to mean more cash in your pocket. So you contribute to CPP on any income above $3,500 up to $61,600. So if your income is between $3,500 and $61,600, you're contributing to CPP, and that could mean over $3,100 of extra cash that's going out of your pocket to CPP. So it could be an advantage to you to stop contributing to save that $3,100 or less, depending on what your income is. So it's something to consider. Now, you may also be thinking, if I stop contributing to CPP, is this going to impact the eventual CPP benefit that I can collect? And the answer is possibly. So it's not going to be the same for everyone. It's going to depend on your specific situation. But basically, your CPP pension is calculated by dropping 8 of your lowest income years and potentially some others. So if you're working after age 65, you may not actually need those working years and those contributions to optimize your CPP pension. So it's worthwhile to look into whether it will increase your CPP pension by continuing to contribute or not. The second fact we're going to look at here is also about CPP, and it's CPP sharing. So this is one that may be new to some on the call. And again, I want to reiterate, this is actually not pension income splitting. That's a totally different thing. So this fact is all about how you can take your CPP benefit and share it with your spouse. And the reason you would do this is because if you were to share your CPP pension with your spouse, you could potentially save on taxes for your household. So in the case of a couple where one spouse is earning much higher income than the other spouse, basically you've got one spouse in a high tax bracket and another spouse in a low tax bracket. If you can take some of that CPP and share it between the two, you'll bring the higher income spouse down in tax and the lower income spouse bumped up a bit in tax, but overall it would result in lower household taxes. And because CPP is taxable income, it's an important consideration as to whether this would help your tax situation. So a few things that are important to note here. The first is that CPP can be shared with a married or common law spouse, and you must apply to share your CPP. So unlike if you're familiar with pension income splitting that's done on your income tax returns, CPP sharing is done by applying through the government by completing a form. So you actually have to apply to share. Now, sharing cannot be backdated, so it only begins once your application has been approved. So if this is something that you're interested in doing because it will offer tax savings to you and your spouse, then I would suggest looking into it sooner than later because they won't back pay. So it's only for moving forward. Also to note that you can stop CPP sharing at any time. It can be canceled. Another form to fill out, yes, but just so you know, it's not something that you start doing and then that's your forever decision. So it can be canceled. So I think CPP benefit sharing is a great opportunity. In particular, if you have a couple where one has contributed to CPP over the years and the spouse has never contributed to CPP, that's a great CPP sharing opportunity. But even if you've both contributed to CPP over the years, one perhaps contributed more than the other, so there still could be a benefit to that CPP sharing. So it's worthwhile looking into, and I think this is a tax advantage that a lot of people don't consider. So I wanted to mention it today. I also do want to mention that if you're thinking about, how do we determine, how much of our CPP can be shared, it is something that can be calculated, and it's based on the number of months that you and your spouse have lived together while you each were paying into CPP. So there's a bit of a calculation behind it, but it's certainly something that can be figured out. All right, so moving on, number 3 is that you don't have to wait until age 65 to collect CPP. You can actually begin collecting your CPP pension as early as age 60, or you can delay collecting as late as age 70. So for every month prior to age 65 that you choose to collect CPP, your pension is reduced by 0.6% per month or 7.2% per year. So when you've received information from the government on what your expected CPP pension will be at age 65, you can actually calculate how much of a reduction you'd receive if you started to take it earlier than age 65. So basically, the government penalizes you for taking it early, you get a reduction. Or if you decide to delay it after age 65, your pension is actually increased by 0.7% per month or 8.4% per year. So there's a unique opportunity here from a planning perspective to determine whether it's worthwhile to take your CPP pension early at age 65 or delay it up to age 70. I wanted to make a note that younger than 70, you do need to apply to start receiving CPP benefits. But as of last year, those 70 or older who have not yet applied to start collecting CPP will be automatically enrolled. The government doesn't want people to miss out on this pension benefit that people have paid into. So automatic enrollment is now happening. So a couple things I wanted to dig into a little bit on this point is you may be wondering how you decide when is the right time to take CPP. There's not a perfect answer for this, and it's very unique for every individual out there, but I wanted to provide some general rules of thumb. So I would say if you need the cash flow, you have limited income and you really could use those CPP payments, consider collecting it early. So even though you will get a reduction versus if you'd waited till age 65 or later, you actually get more payments, right? Because you have it started early. And you also, if you need the cash flow, you get the cash flow when you need it. So I would say, number one thing to think about is whether you need the cash. I would also say that if you're in poor health or you do have a shortened life expectancy, consider collecting it early. because once you pass away, there is a lesser spousal benefit paid. Or if you don't have a spouse, your estate really receives a minimal amount. So, you're going to optimize your CPP income by taking it early in that case and not losing out on, those contributions that you made throughout the years. The third point I want to make on this is that if you're still working in your 60s and you really don't need the income, or if you expect to live into your 80s and 90s based on, family health and your general health, I would say consider delaying your CPP, which will increase your monthly benefit. So what's fantastic about CPP is it's guaranteed and inflation adjusted. So, as the cost of living goes up over the years, which throughout your retirement, we could be talking about 20 or 30 years, the fact that it's adjusted for inflation means that you're going to increase that monthly benefit throughout your life. So it gives you greater security in your retirement if you could have your CPP start off at a higher amount. So again, those are just general rules of thumb. There's not a one size fits all, and it's quite a calculated workup to figure out the exact perfect amount for everybody. But you have to do what's best for yourself, and hopefully some of these considerations will help in that decision. All right, the next slide we're talking through is old age security. This is OAS. It is a monthly benefit for those age 65 years and older. So unlike CPP, where you would have had to contribute to CPP over the years in order to collect, OAS is available, for most Canadians. There are some qualification factors, but you wouldn't have had to pay into OAS, so to speak. In most cases, OAS is paid automatically. There have been some cases where people have needed to apply, but typically it's automatic. You just need to file your tax return so that the government knows about you, and you should start to receive your first monthly payment after you turn 65. However, I think it's also important to note that you can actually choose to delay your OAS up to age 70. You don't have to take it at age 65. Now, delaying your OAS will actually increase your payment by 0.6% for every month that you delay, or 7.2% per year. So strategically, this may make sense for some people to delay their OAS. I would say if you're in a situation where you're working or your income is quite high and you could be facing an OAS clawback, which is around the $80,000 of income mark, you may be best to delay your OAS so that you don't face that clawback and start off at a later age after age 65. So currently, the maximum OAS payment is around $615 a month. And this payment is adjusted quarterly based on cost of living. So as inflation goes up and as the cost of living goes up, your OAS also goes up. So it's another great source of guaranteed income that's adjusted over the course of your retirement. So for those to qualify for OAS, if you're living in Canada, you must be at least age 65 and older, or be a Canadian citizen or legal resident. You must have resided in Canada for at least 10 years since the age of 18. If you want to qualify for the full OAS payment, you will have needed to live in Canada 40 years or more since the age of 18. And OAS is actually available if you're living outside of Canada, but you must have resided in Canada for at least 20 years since the age of 18. So for most of us, we qualify for full OAS because we've lived in Canada our whole adult lives. So the fifth fact we're going to go over is the Guaranteed Income Supplement, or GIS. So this is a benefit that's available for those 65 and older who are collecting OAS. So you must be actively collecting OAS in order to be eligible for GIS. GIS is really a benefit for lower income seniors, likely seniors who have never paid into CPP or are collecting very minimal CPP, and mostly just living off of OAS. So eligibility for the GIS supplement is based on income from the previous calendar year. So July 2021 payments to June 2022 payments are based on the 2020 tax year. As I'd mentioned, that GIS is really available for lower income seniors. You really can only make $5,000 in income from other sources besides OAS and GIS in order to qualify for the full amount of GIS. And when you make income above $5,000 from other sources, your GIS gets clawed back $1 for every $2 of income that you receive. So when you hear of the GIS clawback, that's what we're referring to. So your GIS payment will get reduced $1 for every $2 of income you earn above that $5,000 mark. Now, GIS is a non-taxable benefit. You must file your income tax return in order to qualify. So if you have been not filing your tax return because you feel that you don't have a lot of income or you might not owe any tax, I would say it's very important to file your return because you would be eligible then for GIS. So GIS is not the easiest easiest benefit to understand. There's a lot of different little aspects to it. A few points I wanted to make here was that the maximum combined payment from OAS and GIS is $1,534 a month for a single person. That changes for couples. And GIS is a non-taxable benefit. So even though you do have to report it on your income tax, you don't end up having to pay income tax on the money received. So this is different than OAS and CPP, which are taxable benefits. So a couple other points I wanted to make here. If you are eligible to receive GIS, your spouse may be able to receive the allowance if they're too young to qualify for GIS. So if you're in a low income situation in your household, but your spouse isn't 65 yet and wouldn't qualify for GIS and OAS, then your spouse may be able to receive what's called the allowance. And the allowance is for people aged 60 to 64, Canadian citizens or legal residents, and have resided in Canada for at least 10 years since the age of 18. Now, your combined annual income must be less than $34,500 for your household. So this allowance benefit is a separate benefit that's paid to your spouse. Now, to further add more points to this slide, there's also an allowance for the survivor if a spouse has passed away. For those aged 60 to 64 whose spouse has died and annual income is less than $25,000. So I know when I'm looking into GIS, I feel a bit overwhelmed. So I think it's quite normal that you might be feeling the same. So I did find a number to put on here to call for more information. And I think the things to take away from this slide are that it's really important to file your tax return so that you qualify for this benefit. And know that there's also support for your spouse if your household isn't earning a lot of income from OAS. There is the allowance as well. All right, and the sixth point here It's never too late to start saving using a tax-free savings account. I'm very excited to talk through this point here. Tax-free savings accounts, or TFSAs, as you'll hear them referred to, they've been around since 2009, which means they've been around for 12 years, but a really high number of Canadians are still not using them. And they're very misunderstood. And if you're kind of thinking right now, yeah, I've heard of them, but I'm not really sure how they work or what the benefits are, you're certainly not alone. And I think that's one of the main reasons that people aren't using them is they seem complicated and they're misunderstood. So I wanted to hopefully break down some key takeaways for TFSAs and give you some ideas of how they can benefit you. So the first main benefit of a TFSA is that when you invest in the TFSA, there's no income tax payable on your investment's growth while it's in the TFSA. So if you were to just go and put, money in a bank account or money into a mutual fund, any growth that you earn on that investment, you would normally have to pay tax on. If it's in a tax-free savings account plan, you actually don't have to pay any tax on the growth. So it's potentially a big tax savings depending on the tax bracket that you're in. Okay, so no tax payable on the growth is number one. The second benefit is that when you withdraw from your tax-free savings account, the withdrawal does not get included in your income, and there's no tax to be paid on that withdrawal. This is huge. So if you've had RSPs, you'll know that when you draw out of your RSP, it gets included in your income and you have to pay tax on that RSP income. With tax-frees, they do not work that way. So you can withdraw $5,000, $10,000, $100,000, whatever it may be, from your tax-free savings account. It does not have to get reported on your income taxes, and there's absolutely zero tax paid on that withdrawal. So that point right there makes TFSAs an excellent tool for extra sources of income in retirement and tax planning. The fact that TFSA withdrawals won't impact your government income tested benefits as well is a very key point. So because you don't have to report your withdrawals as income, it doesn't impact your ability to collect GIS. So that benefit we just talked about, how if you earn $2 of income, your GIS gets clawed back $1. You can withdraw any amount from your tax-free, and it's not going to affect your GIS. So tax-free savings accounts are a great tool to use to be able to supplement your retirement income if you're in a low income situation. For others that may be in a higher tax situation and could be faced with an OAS clawback, so if you're earning income over roughly $80,000 in the year, your OAS will get reduced by 15%. So tax-free savings accounts could be a great way to supplement your income and not cause you to have your OAS clawed back. So they can be tax-frees are a great opportunity for both low and high income individuals, as well as everybody in between. So again, the three key benefits are they're essentially tax-free, no tax payable on the growth while they're in there, no tax payable when you withdraw, and no impact on your government tested benefits. So really, I don't actually see any downside at all with utilizing a tax-free savings account. There's only benefits. Now, if you've never contributed to a tax-free savings account, you can contribute $75,500 this year. If you have made contributions in the past, your limit will be different depending on how much you've put in. You can only contribute up to $75,500 as of this year. Now, every year, every Canadian over the age of 18, we all get the same contribution limit. So this year, we all received $6,000 that we could put in. And when we add that all of the other contribution amounts we've received since 2009, we're left with the 75.5. So that's how we get that number. So there's likely a lot of opportunity for you to utilize a tax-free savings account if you haven't been contributing. Now, I wanted to just take a moment to talk about, a big misconception around tax-frees and a big opportunity. So what I see time and time again are people that have tax-free savings accounts that are bank accounts. So you can definitely have a bank account be tax-free, but the tax savings isn't going to be very significant. So I think we all know that you really don't earn a lot of money when you have your money sitting in the bank account, right? There's not a lot of interest income being paid on bank account balances. So therefore, if there's not a lot of growth you're getting from your bank account, there's not going to be a lot of taxes anyway. So there's really not a huge opportunity to use a bank account tax-free savings. Where there is opportunity is that if you have higher growth investments, like mutual funds, or even GICs, where you could be making some more significant interest income off that investment, those are the types of investments that make the most sense within a tax-free savings account. They're going to give you your biggest tax saving opportunity to have them within a tax-free. I wanted to try to illustrate how a tax-free works by including this image on the slide here. So it's an empty box, and that empty box is labeled TFSA. But I think that there's some confusion between what is a tax-free savings account and what is an investment. So if you can think about a tax-free savings account as just an empty box, and whenever you put an investment within that empty box, that investment gets to benefit from the tax-free savings rules. But a tax-free savings account is essentially just the plan and the tax saving benefits. You can choose whichever investment you want to put inside that box. So you could put in a bank account, you could put in GICs, you could put in mutual funds. But the investment is the investment, and the tax-free savings account is the actual plan that gives you those benefits. So two things you need to think about. One is, would a tax-free savings account be a good plan for you to have? And I can pretty confidently say yes, because there's only real benefits from the plan. So we want this box in our lives. What type of investment do we want to put in? Well, that depends on your objectives, your risk tolerance, and your comfort level. Maybe you just want to be invested in GICs because you don't want to take a lot of risk. So just put GICs in the tax-free savings account. Maybe you want to take some more risk and potentially earn higher rates of return. So you're more interested in mutual funds as investments. So you can take mutual funds and put them in that tax-free savings account plan. Or you can include GICs and mutual funds within that tax-free savings account, okay? But the tax-free savings account is just the plan, and your investments are whichever investments that you and your advisor decide make the most sense to meet your objectives and align to the risk that you're comfortable taking. So hopefully that helped to give you a little bit more insight into what a tax-free savings account is, its key benefits, the contribution room that you potentially could have, and just some initial thought processes on types of investments that you could use within the TFSA. That we talked about and just the key takeaways from our presentation today. So the first one is that you can opt to stop contributing to CPP at the age of 65. That may or may not impact your CPP benefit when you start collecting. Number two we talked about was that you can opt to share your CPP pension with your spouse for a combined household tax savings. Now there is a government form you'll have to complete to start that sharing, and then you can always cancel that at any time. The third fact was that you can start collecting CPP as early as age 60 for a reduced payment, or you can delay it as late as age 70 for an increased payment, or you can choose any month in between to start collecting. The fourth fact was OAS, which is a monthly taxable benefit that you can start to receive the month after you turn 65. You can also opt to delay it up to age 70 for an increased benefit, which will continue for the rest of your life. We talked about GIS, which is an additional benefit for lower income households. Plus, there's an allowance for the spouses age 60 to 64 who aren't yet receiving their OAS. And then the sixth fact, which is it's never too late to start saving. And tax-free savings accounts are a great tool to tax shelter your growth, which means no income tax payable, and it gives you flexibility for withdrawals and no inclusion in your income. So no tax when you withdraw, and no impact to GIS and OAS. All right, so that is the presentation, and I just wanted to thank you all for your time and your engagement. And I think at this point, we're going to switch to questions. And before we do that, I just wanted to say I appreciate that